5-star copies all. Go ahead. Message to observer. Alpha 3 rounds. AT delay in effect. 3 guns. Bravo 2 rounds. 2 guns. Smoke on effect.
Hello and welcome to the Options Millionaire YouTube channel. Thanks for watching another video from the educational series. As we're kicking off yet another bull rally up to 3,900, where we've been since about the beginning of December. If you've been following me along in the Discord, you know that I am looking to put on a longer short position, and I'm looking to do so in the form of a debit spread. So in line with this theory, today we're going to be talking about debit spreads. I've already released a video about credit spreads a couple of months back. If you haven't seen that, that is what the thumbnail looks like. Go take a look in the educational series. Link is down in the description of the video. Today, we're going to be talking about debit spreads, though, the opposite of a credit spread. A debit spread is the exact opposite. You're buying premium closer to the money and selling premium further away from the money. If you've never dabbled in debit spreads before, I'd encourage you to watch to the end of the video because there's a lot of great reasons why you would rather take a debit spread instead of just a long put. In my opinion as well, I think a debit spread is the gateway to writing premium, which I think every single investor who's in option trading should learn to do is write premium. And debit spreads is a good segue. It's a good door opener into writing premium to understand just what happens when you start writing premium as to just longing premium. So to start out, what is a debit spread? First, let's go over the pros and cons of why you would actually want to do a debit spread as opposed to just longing a put or longing a call. So the pros: lower cost and max loss. The lower cost allows you, if you have a smaller account, to be able to play directionally instead of taking a longer put, especially in a higher IV environment, in a higher cost environment, higher premium environment. If you can't really afford the premiums, then you could play a debit spread to reduce your cost because you're selling premium to offset the cost of the long put. Again, we'll go over some examples in a bit. Second is going to be max loss. It's going to cap your losses. So if you're wrong, you're not going to take as big of a hit as if you're just long in a put. And on the flip side of max loss, the main con of taking a debit spread is the fact that it caps your profits as well. So you are reducing your risk profile, but as with all things in investing, when you reduce your risk, you also reduce your potential for profit. For me, the debit spreads increase your probability of profit. You are writing premium to offset the effects of theta decay, which allows you to be a little bit more speculative on a direction of a stock price. In addition, debit spreads are actually positive vega. And vega comes into play with IV spikes. So as opposed to a credit spread where IV spike would hurt your credit spread because it would reduce your decay, a debit spread would work in your benefit for IV spikes because it's positive vega. Now, vega is not really discussed all that much in the intricacies of option trading, but what is vega? Vega measures an option sensitivity to implied volatility. It's actually the change in your option premium per 1 point in implied volatility. So if implied volatility were to change 1 point, your options premium would change the amount of vega. And when you have a positive vega, such as a debit spread, when you have a big spike in IV, then it's going to benefit your premiums. Debit spreads are usually best used for hedging purposes. If you've got an underlying portfolio like stocks or just an underlying options portfolio and you want to hedge against downside, you would put on a debit spread. However, you can play directly with them, and I do so frequently. And that's exactly how we're going to apply them in this particular video to keep it nice and basic. So let's get into some examples. Let's say the current price of SPX is $38.95, as it is right now, and you wanted to put on a 3,800 debit spread, meaning you think the price is going to start to decline the next week. Let's say you take your expiration a week out, and you think the price is going to go to 3,800, but you don't want to put on just a long put, just in case we enter into a couple of days of consolidation, which theta will start wreaking havoc on your long put. Instead, you want to take a debit spread. So what you'll do is you come down, zoom out a little bit, and come down to 3,800. So you would take a 3,800 long put. You would buy a 3,800 put right there. Now let's say on this 3,800 long put that you pay $10. Now, in order to turn this into a debit spread, we have to go further outside the money or a cheaper premium. Let's say we turn this into a 30 wide, 37.70. And this is where we want to sell a 37.70 put right there. Now, let's say the cost of that is $7. Now, since you've bought premium at $10 and you sold premium at $7, that would leave you with a net debit of $3. So your net cost of this position is $3 or $300 per contract. Now, what does this position allow you to do? This position allows you to speculate on the direction of the market to the downside, obviously, because we're doing a put debit spread, which is a bearish position, while having some short protection here in the event that theta starts to come into play if you get a consolidation period. And it's really that basic. It's really that simple. There's not much to it. You just long a put that's closer to the money, you short a put that's further outside the money, and this is your spread position. Now, there's a couple of different advanced ways to manage this position if you're so inclined. If things start getting super bearish to the downside, what you could do is close out your short position and leave on the long put as this thing continues to plow through. Or if we get some sort of bad news, global political news that will really cause some bearishness in the market, you could close the short put, leave the long put on, and just let this thing eat. And that way you've closed your protection against theta, your short leg, and leave your long put on. But that's a little more advanced theory. We're not going to get too far into it. But there's a whole bunch of different examples on how you can manage this position other than just simply opening and close this position. Obviously, the most basic is just to close and open these together as one single position. But as you get deeper into writing premium, there's a whole bunch of different examples and ways to manage this position to get you in and out of jams. Now, this is a put debit spread. Let's take a look at what a call debit spread looks like. So using the same 38.95 SPX right here, let's say we wanted to take a look at 39.70 call debit spread. So first, we would come up to 39.70 and buy a 39.70 call. And this call is going to cost you $12. So then you're going to do a 30 wide, so you're going to go up to 4,000, and you're going to sell a 4,000 call of the same expiration. And you sell that call for $8. So when you long the premium at $12, you short the premium at $8, that leaves you with a net debit of $4 or $400 per contract. So now you're playing directional or have a bull bias up to 39.70 and beyond. So if this price starts to climb and climb and climb, you make money. And the great thing about these debit spreads is that they're very versatile. You could play short expirations, you could play long expirations, you can combine them with regular options, etc., etc. There's a whole world of debit spreads that you can start diving into that takes some risk off of your plate instead of just longing options altogether and being wrong and having theta destroy your position. These are also great if you want to play catalyst events such as CPI, FOMC, all these different crazy bear market catalysts that we have. You could play these debit spreads to offset your losses. And speaking of that, one more advanced theory that you could really do with these things is that as you get more and more savvy into selling premium, you could start flipping these back and forth into debit spreads. And you do those through your deltas, managing your deltas. What do I mean by that? Well, let's say you've placed this exact 1 week out call debit spread right here. The price starts to climb, the price starts to climb right here. And then all of a sudden, we get something that changes the underlying nature of the market, whether it be some sort of catalyst, a negative data posting, some sort of crazy geopolitical event that turns things very bearish, and we start to have a major downturn in the market. Well, what you could do, instead of just closing out this whole position altogether, you could be a little more savvy and start adjusting this position. So instead of just closing out the whole position, what you could do is close out just the long leg, and then you can come around and buy a long call above, essentially turning this, swapping this into a credit spread, thus a bearish position. And as this price action starts to turn on back down, now you've made money on the upside, and now you're making money on the downside as well. Obviously, it's a more advanced theory. We can talk more about that in a later video, but it just goes to show you how versatile these positions can be if you know how to manage them. Okay, so you reach this point, you think that the market's going to continue down here. You put on a 3900, 3870 put debit spread, a 30 wide, 1 week out put debit spread. So you enter some chop right here. And now what happens here with the benefit of a put debit spread on this particular price action is that obviously you're in a bearish position. So as the price keeps going up or consolidates, this short put is going to get cheaper and cheaper, thus gaining you money and offsetting your losses from the long put. And it enables you to hold through a little bit of chop. So the price starts chopping a little bit more like this, and then boom, you get this big catalyst drawdown here. Maybe this was a news event, maybe holy crap, things are starting to really turn sour, and I think, all right, now the market's really ready to start dropping. So you can take off your protection, or you could close the short put here, leave on the long put, and now you could start making money on the long put only, just like a normal bearish position, right? So the short put buys you time that offsets theta with the reduction of the short premium, making you money. So when you close that position and now just leave long puts, you could bring it on. Now, you very well could leave on the short put as well and still make money on this drop because it's a debit spread, right? It's a bearish position. However, once you become deeper in the weeds and more knowledgeable on this, you can get a little more savvy, close out the short put just at the right time, make money on collecting premium on the short put, and now you've just got a basic long put all the way down. This premium goes to $20, $30, $40, and you make money and chop, and you make money on the downside. The easier way to manage that position, just leave it on and let the put debit spread eat. The harder way to manage that position, do what I just explained. Close out the short put, let the price action fall, and you gain money on the long put. Anyway, that's pretty much it. Nice and easy peasy explanation of some debit spreads. It's really not that difficult. I highly encourage you to learn how to do debit spreads because, once again, I think debit spreads are a gateway into writing premium, which I think everyone should. If there was one thing I could go back and tell myself when I first started trading over 11 years ago is, hey, start to learn how to write premium. Even if you don't do it, learn understanding of writing premium because it'll change your perspective on the market and it'll help you understand how the institutions are positioning themselves in the market because the institutions are premium writers. And if you understand the liquidity providers and the premium writers on the backhand, then you will understand how the market starts to work. But that's all I got for you. If you haven't already, please hit that like and subscribe button. It helps gain notoriety for the channel as well as helps you get notifications for all Monday, Wednesday, Friday live streams and future educational content. In addition, come over and join the Discord. Link is down in the description of the video. It's a fantastic educational communal resource where we could share ideas, have some fun, and make a little money along the way. In addition, I've got a podcast that's growing more and more on Spotify, the Making Millionaires podcast. Link is also in the description of the video. Try to post an episode every week or so to help you benefit and grow your financial life. And I appreciate you taking the time to watch this video. Until next time, I'm Andrew with the Options Millionaire Community, and I'm out. See ya.